Living off passive income is entirely possible, but the version of it you usually hear about is, frankly, a lie.
The internet loves to sell the idea of making money while you sleep. Painting a picture where you buy a few assets, set up a funnel, and then spend the next 40 years drinking margaritas on a beach while cash magically appears in your checking account.
But in practice, true hands-off passive income is fragile, incredibly expensive to buy, and far slower to build than anyone admits. For the vast majority of people who actually achieve financial independence, the reality isn't zero work. It is a messy, evolving mix of investment withdrawals, semi-passive side hustles, and active management.
Today, I want to take apart the math, the risks, and the psychology of living without a paycheck.
Because if you build this wrong, you don't just lose income, you lose your freedom.
Before we dive into the spreadsheets, I want to make sure you stick around for the second half of this breakdown, because that is where we get into the psychology. It is a real problem. Also, if you appreciate deep dives that respect your intelligence and your wallet, go ahead and hit that subscribe button.
It is the best return on investment you will get all day.
Now, in plain terms, living off passive income just means your assets generate enough cash to cover your bills without you trading hours for dollars.
This usually comes from two main buckets. The first is the cash flow model, like dividends or rent. The second is the total return model, where you sell off small pieces of your portfolio over time. Most people fight over which is better, but the smartest people I know usually end up using both. Let's start with the math behind the phrase, never work again. If you have been in the financial independence space for more than 5 minutes, you have heard of the 4% rule. This is the classic rule of thumb, derived from research by William Bengen.
It suggests that if you invest in a diversified portfolio of stocks and bonds, you can withdraw 4% of that portfolio in your first year of retirement.
The inverse of 4% is 25. That gives us the quick napkin math everyone uses. Your target portfolio needs to be 25 times your annual spending. So, if you spend $40,000 a year, you need $1 million invested. If you spend $80,000, you need $2 million. It sounds simple enough on the surface. Here is where the math gets messy. The 4% rule is not a guarantee. It is a probability based on historical U.S. market data.
More recent research, specifically from places like Morningstar, suggests that in certain economic environments, especially ones with high valuations and low bond,
they have argued at times for something closer to 3.3 or 3.7%.
That might sound like a tiny difference, but let's run those numbers. If you need $40,000 a year to live, and the safe withdrawal rate is actually 3.5%, you do not need $1 million.
You need closer to $1.15 million.
That is an extra $150,000 you have to save, just to generate the exact same lifestyle.
And remember, this model isn't technically passive income in the traditional sense. You are selling assets. You are slowly liquidating your position, betting that the remaining money grows faster than you can spend it.
The other trap in this math is inflation. People often say, I have $1 million, so I can pull out $40,000 forever.
But $40,000 today buys a lot less than it did 10 years ago.
If If inflation runs at just 3%, in 20 years you will need roughly $72,000 just the same groceries and pay. If your passive income is fixed, say from a corporate bond or a non-adjusted annuity, you are effectively getting a pay cut every single year. This is why the total return model is so popular. Stocks have historically outpaced inflation, acting as a natural hedge. If you rely purely on fixed income, you might feel safe in year 1, but by year 15, you could be living near the poverty line without realizing how you got there. So, what is the protocol here? If you are building a withdrawal-based passive income plan, you need a margin of safety. Do not plan for the best-case scenario. Plan for the boring, mediocre scenario. Many experts suggest aiming for a withdrawal rate between 3.5 and 4%. But retaining the flexibility to cut your spending if the market tanks. If you can live on 3% of your portfolio during bad years and 4% during good years, your chance of success skyrockets. The math tells us that flexibility is actually more valuable than just having a bigger pile of cash. Now, you might be thinking, Tom, I don't want to sell my stocks, I want pure cash flow. I want rent checks and dividends that just show up so I never have to touch the principal. That is the dream, right? But if you think the stock market math is tricky, wait until you see the trap waiting for you in the world of pure cash flow. This is where most people underestimate the cost by about 50%. The cash flow model is what most people visualize when they say passive income. The idea is that your assets pay you directly. You own 10 rental units, netting you $4,000 a month. You own a massive dividend portfolio, sending you quarterly checks. You have royalties from a book you wrote 5 years ago. In this model, the principal, the golden goose, is never touched. You just live off the eggs. On paper, this feels infinitely safer than the withdrawal method, because you aren't selling anything. If the market crashes, you theoretically still get your rent check. It feels tangible, it feels robust. And that feeling of safety is exactly why so many people rush into it without doing the due diligence. Here is the trap. Revenue is not income. I see this constantly with real estate. Oh! Someone buys a duplex and says it rents for $2,000 a month, so that is $24,000 a year in passive income. No, it is not. That is gross revenue. From that, you have to subtract property taxes, insurance, repairs, vacancies, management fees, and capital expenditures like a new roof every 20 years. Once you strip all that away, your net passive income might be closer to $600 a month, not $2,000. And that is before income tax. To replace a $40,000 salary with net rental income, you don't just need 1 or 2 houses. You might need 10 or 12 units free and clear. Suddenly, you are not a passive investor. You are a property manager with a very expensive hobby.
Real estate is scalable, yes, but it is rarely truly passive unless you are paying a management company which cuts into your margins even further. The solution isn't to avoid cash flow assets, but to treat them as a stabilizer, not the whole engine. Most successful early retirees I know use a hybrid model. They have a core portfolio of index funds for long-term growth and withdrawals, and they layer in some cash flow to cover the basics. For example, maybe your rental income covers your groceries and utilities, the absolute essentials. That way, if the stock market crashes, you know you can still eat and keep the lights on without selling shares at a loss. You use the reliable, semi-passive income to lower the stress on your portfolio. You don't need the cash flow to cover everything, just enough to let you sleep at night. Now, we have looked at the income side, but there is a variable in this equation that is actually 10 times more powerful than your investment returns. Most people obsess over how to earn an extra 1% on their portfolio, but I am going to show you why cutting your expenses by 1% is actually worth double that in terms of freedom.
This is the part of the equation where you can cheat the math.
The critical variable is spending, not income. Financial planners often use a formula to determine your freedom number. It is your annual expenses multiplied by 25, assuming that 4% rule holds up. This means every dollar you spend requires $2055 of invested capital to support it forever. It's called sequence of returns risk. Think about that. That monthly Netflix subscription isn't just $15. It represents $375 of capital you need to accumulate and keep invested, essentially forever. A $500 car payment? That requires $150,000 in your portfolio just to sustain that one line item. When you view your expenses through this lens, the cost of luxury isn't just the price tag. It's the years of freedom it costs you to accumulate the backing capital. Attack the spending side first. It is the only variable you can control completely today. We need to talk about the monster in the closet. The one thing that can destroy even a perfectly calculated passive income plan. It's called sequence of returns risk.
If you ignore this, you could do everything right. Save the money, buy the assets, quit your job, and still go broke within 5 years.
It all depends on what the market does the day after you give your 2 weeks notice. Sequence of returns risk basically says that the order in which your investment returns happen matters just as much as the average. Let's say you expect an average 7% return over 30 years. If the market crashes 20% in the first 2 years of your retirement, while you are also withdrawing money to live, you dig a hole so deep that you are selling shares at rock-bottom prices to buy groceries. This permanently depletes your capital base. Conversely, if you get a bull market in your first few years, you are practically invincible.
It is luck of the draw, and it is terrifying because you cannot predict it.
The protocol to fight sequence risk is the cash buffer or bond patent. The idea is to keep 1 to 3 years of living expenses in cash or short-term bonds when you first retire. If the stock market crashes in year 1,
You don't sell a single share. You spend your cash buffer. You live off the savings account and let your stocks recover.
Once the market bounces back, which historically takes a couple of years, you replenish the cash buffer.
This acts as a shock absorber.
Yes, holding that much cash drags down your long-term return slightly, but it buys you insurance against the worst-case scenario. It ensures you never have to sell a stock when it is down 20% just to buy a sandwich.
We have covered the money, the risks, and the math, but there is one final hurdle that almost nobody talks about until they hit it face first.
It is the reason why so many people achieve financial independence and then go back to work within 18 months.
It has nothing to do with inflation or stock prices. It's about what happens to your brain when the alarm clock stops ringing.
There is a distinction in the FIRE community, financial independence, retire early, between retiring from something and retiring to something. If you are just running away from a job you hate, you will likely crash and burn once the initial euphoria wears off.
A week at the beach is paradise. A year at the beach is a crisis of purpose. Ah!
We derive a huge amount of our social status, social circle, and sense of utility from our work.
When you strip that away abruptly, you are left with a void. I have seen financially independent people spiral into depression because they underestimated their need for structure and challenge. The myth is that humans are designed for endless leisure. We aren't. We are problem-solving machines. Without problems to solve, we invent them. You might find yourself obsessing over the lawn or arguing with strangers on the internet just to feel some engagement.
The most successful passive income earners don't actually stop working.
They just stop doing work they hate. They shift to optional work. They shift to optional work.
Maybe they start a passion business, volunteer, or consult on their own terms. The goal of passive income shouldn't be to do nothing. It should be to have complete autonomy over what you do.
Thanks for watching, and I'll see you in the next one.